Okay, so George Buckley, thank you for taking the time to come here to the Work Economics Summit. I hope you're enjoying yourself here. Yeah, so I'm going to start with maybe looking back at the year in the past. You came to Wes Presents and you held a speech on the recovery, and you asked the question, what can it last? So now, a year later, are we better poised to answer this question?
Yeah, well, it has lasted. We've seen the economic recovery quite positive in the UK. We've seen growth of about 2.5% last year. We think it will continue this year. And after all, we've got very low interest rates. We've got 375 billion of QE in the economy. The US is recovering well. Europe, of course, our biggest export market. We've just seen some GDP figures, for example, from Germany, which are a bit more encouraging. The Eurozone grew by 0.3. Now, 0.3 is not very strong in absolute terms, but for the Eurozone, I think that's quite a result. So things are recovering. We are recovering from a very low base. So we're only 3.5% back above the previous peak, which is not a good result if you were to take us back, let's say, 5 years and realise that it was going to take us so long to get out of this mess. But I think this is fairly par for the course. If you look at the US, for example, they have recovered much slower than we thought originally, and certainly relative to previous cycles, just like we have.
Do you think the coalition's austerity policy has made things worse or made things better, or is it balanced? Yeah.
I think when you cut back on government spending, like austerity always will do, mostly will do if you alongside high tax rates. When you do that, it is going to cause weaker economic growth in the near term.
Yeah.
But you've got to think about the longer term issues here. If you have very high levels of government debt and government deficit, then it's going to cost you more to borrow in the financial markets. And therefore, if you do cut back, it will encourage lower rates. It will allow the Bank of England, for example, to keep interest rates lower for longer. It will mean that private companies will be able to borrow for lower costs. So I think in the longer run, austerity is good for economic growth. In the short run, of course, it will cause near-term weakness because government spending, after all, is one component of GDP on the expenditure side. So it will
so
directly
it's kind of a trade-off, obviously. It's not.
Yeah, I think it's important through the near-term pain that you have to go through to. But you have to do it at a time which is right for the economy. You can't do it when the economy is on its knees, and that's why, for example, back in 2008, 9, 10, the government was providing substantial fiscal stimulus.
The current economic climate has changed markedly since the so-called Great Moderation, where we have fairly low levels of inflation and low unemployment. Apart from the financial crisis, what are the key trends and determinants of that? Why have things changed so markedly, and why is low inflation not enough anymore, seemingly to?
I think central banks are right in that they still should target inflation. We have very low rates of inflation at the moment. I think central banks need to think about looking through some of these low rates of inflation when they set policy, because you have base effects when oil prices fall, as they have done largely because of supply reasons. It means that if they stay at these levels in a year's time, at the points at which a year ago we saw big falls in prices, inflation will bounce back. You can see when you read the Bank of England's minutes that they're very concerned about the almost opposing possibilities of either deflation becoming entrenched or further disinflation becoming entrenched, or on the other hand, inflation coming back with a vengeance. And it's clear that they don't really know which one of those is going to happen. If low inflation generates low inflation expectations, that might mean that people put off spending decisions. It might also feed back into lower inflation expectations. On the other hand, of course, if low oil prices generate a significant increase in demand because it's freed up a lot of cash which would have otherwise gone to oil-producing nations in the UK, then that will be very positive for growth. It might mean that we move more quickly to an above-trend position, which would mean higher inflation. So it's a very uncertain outcome, and I think that's really what central banks are now trying to grapple with, which one of those outcomes is more likely.
Can we learn something from Japan? I mean, they've had the so-called lost decade, they've had to fight deflation. Is there anything the West can learn from Japan in responding?
What Japan did was, I think they moved policy a little bit too late. They cut interest rates too late. They recapitalised banks too late. So I think we have learned from that process that it was done more quickly in the UK. I think the ECB's probably learned that maybe they should have done a bit more earlier. But that said, I think it's also important to bear in mind that quantitative easing, all it's doing is bringing forward spending from the future to today. And what it does is smooth economic growth out over time. It doesn't generate any new economic growth. And therefore, you need to think about what conditions might be if you do loosen policy excessively now, what might happen in the future when we have snatched that growth from. And do you need to do more policy then? If it's a case that quantitative easing is simply delaying the plans of states in the Eurozone from adopting more fundamental, underlying real economy changes to their structural reforms, then that's a bad thing. You need to encourage economies to continue to embark on these structural reforms, even if the temporary boost from the central bank is suggesting that they don't need to.
Do you think monetary policy these days plays a more pivotal role in economic policy? Certainly, with the whole austerity argument, it seems to be.
Well, I think both fiscal policy and monetary policy are really up against the buffers.
Yeah.
We've reached the zero lower bound, although that doesn't really seem to be a lower bound anymore because some central banks have even pushed rates through that zero lower bound, only modestly, but they've gone through. Quantitative easing is helpful, but again, it's helpful at the margin. It might be less helpful when you do subsequent rounds of quantitative easing as opposed to the first round of quantitative easing. So I'm not convinced that that is going to be as important going forward. And also fiscal policy is also against the buffers. You can't really do much more in terms of loosening fiscal policy without generating a sizable rise in your level of government debt and deficit. So realistically, I think all policies are really
Somehow be coordinated.
yeah, they need to be coordinated and have been in a way because central banks have been saying we'll keep rates low as long as you continue on the fiscal austerity route, and with various levels of success, more success perhaps in the UK than, for example, in Europe, particularly when it comes to structural reforms. But all policies, I think, at the moment, fiscal and monetary policy, are unable really to loosen substantially more without causing some sort of problem, which means that if you do get another recession, there is very little that central banks or government can do to fully offset it as they could do when interest rates were substantially higher or when governments were more flush with cash.
I'd like to move on to the current Greek crisis and hear your views on that. I mean, how can Greece get out of its current mess? They've got so much debt. Should the EU try and restructure that debt? What are the incentives there? I think a lot of the European states are actually holding that debt, so probably it's not in their core incentive to debt restructure. But should they be doing something like that, or what is your view on that?
I think the European Union has to walk a very fine line between, on the one hand, not being so stern with Greece that it causes Greece to leave.
Yeah.
Because if Greece leaves the European Monetary Union, it means that other countries can as well. And what will happen is that you will see that interest rates on the debt, which has been taken out by some of the peripheral economies, maybe Italy, Spain, Portugal, if you want to call Spain periphery, that will rise. It will mean that they have to build a risk in for when you lend money to these countries that they may not stay in the European Union. On the other hand, you don't want to be too lenient with Greece because that generates a moral hazard issue. It means that other countries might think about trying to also suggest that the European Union be more lenient with you and therefore cancel debt, extend the time over which it needs to be paid, lower interest rates on that debt, and you can't do that for everybody. It will encourage other parties, for example like Podemos in Spain, to do a lot better, and therefore I think you need to strike this very fine balance between being too lenient and therefore moral hazard and being too strict and causing a country to leave the Eurozone.
What do you think about the future of the euro? A lot of people say that monetary integration is impossible without fiscal integration. I think right at this moment, above all with the current election coming up in May, I mean that's a very sensitive topic, at least for Brits here. I don't think a lot of people want more integration with the kind of EU framework apart from economic growth.
I think you do need more fiscal integration in order to allow the euro to survive in the long term. And what typically happens is that a crisis will generate the need for big changes such as political integration, which we've seen, such as the banking union, etc. These fiscal compact, all of these things have been generated and done because of the crisis in the first place. You don't often see much done when there's no need for them to be done. So crises can often really focus the mind, and I think that's what's happening this time. It might yet take another crisis before we get maybe many more. After all, think of how long it took, for example, for the US to achieve its monetary and fiscal and political union. A long time, including a civil war. This would be the fact that people talk about it's been 15 years since the euro was set up and was starting problems. 15 years is nothing in the grand scheme of things, so it could take a lot longer.
I'd like to move the debate on and look at regulation. So there's been a lot of regulation since the financial crisis, and we heard Victor Constancio talk about the shadow banking industry. So what exactly is the shadow banking industry, and why has it become so important in recent years, certainly after the financial crisis?
Well, I think people have moved away from typical bank financing. And the big problem with the shadow banking industry is we don't really have a great deal of detailed data on what's happening in that industry. And that's why it's called the shadow banking industry. So it's moved away from, and you can understand why it has developed in the way it has, because simply the regulations have become a lot tougher. You need to hold more capital, you need to adhere to all of these international standards, the Basel Committee, for example. All of these things are much tougher on banks, and it obviously is going to give a boost to those banks and financial companies who are trying to set up outside of the normal sphere. So I think that's why it's happened, and I think central banks need to be much more alert to this. Look at, for example, China, where the shadow banking industry is causing serious concerns about what might happen to financing there. Very important to keep a close eye on.
Okay, I've got another question about regulation. So during my studies, I came across Goodhart's law, and one popular version of it says, when a measure becomes a target, it ceases to be a good measure. Now, if we have a think about the new Basel III regulation, there's a lot of target ratios, liquidity ratios, risk-weighted assets. How can you square that with Goodhart's law? Wouldn't that imply that regulation is maybe not the best thing, or specific targets are not the best thing?
Well, I mean, this is doing something to address the current problems, and what we saw. It's almost the horse has bolted, and we're closing the stable door. But then again, it's actually preventing all the other horses coming out as well. So it is doing some good. The problem is that this is one crisis, and it will take other crises in the future, maybe a long time in the future, until we realise that there are other things that we have neglected, which we don't really think about at the moment. Maybe the shadow banking industry needs to be regulated more aggressively. But we learn over time the mistakes that we've made. And I think what we've seen in terms of regulation, in terms of improving capital standards, what we've seen there is certainly good for banks over the long term, because it means that if you hold more capital, yes, it's going to reduce how much you can lend. There have been many banks who have had to de-risk. They've had to reduce the amount of assets they hold on their balance sheet, and for that reason, lending has slowed. But it's important to do this because lending will rise in the future to the extent that the rates of interest that banks will have to pay to get their funds in will be lower, because people will trust them more because they've got more capital.
I think I'd like to conclude this interview with your outlook for the rest of the year, maybe for the UK.
Well, we're reasonably positive. We have, for example, growth rates 2.5%. Inflation might well surprise us on the downside in the near term. Wouldn't be surprised if it goes negative in the next few months. But banks should look through that, and I think the central bank may not raise rates this year, but I think they'll be raising rates shortly afterwards. When rates do rise, they'll be doing it very slowly, very moderately, not putting too much pressure on households and potential home buyers. Central banks do not set interest rates in a vacuum. They have to think about these things, and people are a lot more sensitive now to changes in interest rates, simply because how high house prices are. So I think low for long interest rates, rising very slowly. GDP growth running at a decent rate, 2.25% to 2.5%. Inflation falling near term but rising towards the end of the year. Big uncertainty being the election. What do we get in terms of fiscal policy after the election? Well, that's anybody's guess.
Will certainly be interesting. Good. On that note, I would like to thank you for the interview and taking time to come into the Economic Summit.
Thank you very much.